Welcome, guys. It is Thursday night, June 19th, in preparation for Friday, June 20th. Today was a day off trading, so it felt to me like it was Sunday night already again. But nope, tomorrow's Friday, so I got to be aware of that Friday environment thing. But all right, let's jump in here. We're going to finish up. We're uh, going through the Market Wizards interview with top traders by Jack Swagger, William O'Neill, and then we'll jump into the homework for Friday the 20th. Okay, the final item on my list of your most prominent conventional wisdom targets is diversification. This is from Jack Swagger. And then William O'Neill says diversification is a hedge for ignorance. I think you are much better off owning a few stocks and knowing a great deal about them. By being very selective, you increase your chances of picking superior performers. You can also watch those stocks much more carefully, which is important in controlling risk. Keep in mind this section two is more about stocks more so than futures or options. So, but there's still good lessons I feel like we can apply to the futures market. All right, then Swagger says, how many issues would you advise a typical investor to hold at any one time? William O'Neill says, for an investor with 5,000, one or two, 10,000, three or four, 25,000, four or five, 50,000, five or six, 100,000 or more, six or seven. All right, jumping on down here. Swagger says, earlier you talked about using volume as a cue that the market averages were topping. Do you also use volume as an indicator in trading individual stocks? William O'Neill says, the volume in a stock is a measure of supply and demand. When a stock is beginning to move to new high ground, volume should increase by at least 50% over the average daily volume in recent months. High volume at a key point is an extraordinary valuable tip-off that a stock is ready to move. However, he says, volume can also be used as in a reverse manner. When prices enter a consolidation after an advance, volume should dry up very substantially. In other words, there should be very little selling coming into the market. During a consolidation, declining volume is generally constructive. Um, Swagger says, how do you handle a losing streak? He said, if you hit a losing streak and it is not because what you are doing is wrong, that tells you that the whole market may be going bad. If you had five or six straight losses, you might want to pull back and see if it's time to start moving into cash. Swagger says, the M in your CAN-SLIM formula emphasizes the importance of being out of the market. By the way, if you don't know what the CAN-SLIM method is, it's actually really cool method. Just Google it. It'll tell you about what the CAN-SLIM is. Anyway, kind of a little rabbit hole if you choose to go down that. But anyway, at least on the long side, during major bear phases, since most mutual funds, by their very structure, remain heavily invested in stocks throughout both bull and bear markets, does this imply that you believe that mutual funds are a poor investment? William O'Neill says, this is going to surprise you. I think mutual funds are an absolute outstanding way to invest. I believe that every person should own their own home, own real estate, and have an individual stock account or own mutual fund. Those are the only ways you can make any substantial income above your salary. All right. And then way over here on the next page, it says, along that line, what are the biggest mistakes that investors generally make? William O'Neill says, in my book, I have a chapter on 18 common mistakes. The following list of common mistakes is excerpted from O'Neill's book, How to Make Money in Stocks, published by McGraw and Hill in 1988. Number one, most investors never get past the starting gate because they do not use good selection criteria. They do not know what to look for to find a successful stock. Therefore, they buy fourth rate, nothing to write home about stocks that are not acting particularly well in the marketplace and are not real market leaders. Number two, a good way to ensure miserable results is to buy on the way down in a price, buy on the way down in price. A declining stock seems a real bargain because it's cheaper than it was a few months earlier. For example, an acquaintance of mine bought International Harvester at $19 March of 1981 because it was down in price sharply. Seemed to be a good bargain. This was his first investment, and he made a classic trios mistake. He bought the stock near its lows for the year. As it turned out, the company was in serious trouble and was headed at that time for possible bankruptcy. So yeah, just because you're getting it cheaper doesn't mean you're getting a good deal. Number three, an even worse habit is to average down in your buying rather than up. If you buy a stock at 40 and then you buy more at 30 and average out your cost at 35, you are following up your losers and mistakes by putting good money after bad. This amateur strategy can produce serious losses and weigh you down with a few big losers. Number four, the public loves to buy cheap stocks selling at low prices per share. They incorrectly feel it is wiser to buy more shares of stock in round lots of 100 or 1,000 shares, and this makes them feel better. Perhaps more important, you would be better off buying 30 or 50 shares of higher priced surrounding companies. You must think in terms of the number of dollars that you are investing, not the number of shares that you can buy. Buy the best merchandise available, not the poorest. The appeal of a $2, $5, or $10 stock seems irresistible, but most stocks selling for $10 or lower are there because the companies have either been inferior in the past or have had something wrong with them recently. Stocks are just like anything else. You cannot buy the best quality at the cheapest price. It usually costs more in commission and markups to buy low price stocks, and your risk is greater since cheap stocks can drop 15 to 20% faster than most of your higher price stocks. Professionals and institutions will not normally buy the $5 and $10 stocks, so you have a much poorer grade following and supporting these low quality securities. As discussed earlier, institutional sponsorship is one of the ingredients needed to help propel a stock price higher. And I have a side note that's why futures are good. There's good liquidity. Institutions are heavily vested in the futures. They're a really robust entity, and it gives you a lot of leverage with oh holy crap, you can have what $4,000 in an account and trade one ES. That's pretty crazy leverage if you ask me. Number five, first-time speculators want to make a killing in the market. They want too much, too fast, without doing the necessary study and preparation or acquiring the essential methods and skills. Number six, mainstream Americans delight in buying on tips, rumors, and stories, and advisory service recommendations. In other words, they are willing to risk their hard-earned money on what someone else says rather than on knowing for sure what they are doing themselves. That's why we have our group here, guys. Everybody's telling what they're seeing. Everybody's developing their own strategy. I think that's great. Don't jump on somebody else's strategy if you do not understand. You got to understand where profit targets should be reasonably put at, where stop losses should reasonably be put at. It should be your own system. Number seven, investors buy second-rate stocks because of dividends or low price earning ratios. Dividends are not as important as earnings per share. In fact, the more a company pays in dividends, the weaker the company may be because it may have to pay high interest rates to replenish internally needed funds that were paid out in the form of dividends. Number eight, people buy company names that they are familiar with. Names they know just because they used to work for General Motors does not mean that General Motors is a good stock to buy. Many of the best investments will be names that you will not know very well, but could and should know if you would do a little study and research. Number nine, most investors are not able to find good information and advice. Many, if they had sound advice, would not even recognize or follow it. It is always exceedingly small minority of your friends, brokers, or advisory services that are successful enough in the markets themselves that merit your consideration. Number 10, over 98% of the masses are afraid to buy a stock that is beginning to go into new high ground, price-wise. It just seems too high for them. Personal feelings and opinions are far less accurate than the markets are. I like that. Matter of fact, I highlighted that one twice, underlined it. Personal feelings and opinions are far less accurate than what the market is telling you. And I appreciate what everybody's input is when somebody's in a trade. We're giving internals of what the internals of the market's doing, what those things are. What the market's actually doing is that contrary to where the direction we're in that trade. Great stuff in the room, by the way, guys. The majority of unskilled investors stubbornly hold on to their losses when the losses are small and reasonable. They could get out cheaply, but being emotionally involved and human, they keep waiting and hoping until their loss gets much bigger and costs them dearly. I'm skipping over number 12. Number 13, individual investors worry too much about taxes and commissions. Your key objective should be first to make a net profit. Excessive worrying about taxes usually leads to unsound investments in the hopes of achieving a tax shelter. At other times in the past, investors lost a good profit of holding by holding on too long, trying to get a long-term capital gains. Some investors even erroneously convince themselves they cannot sell because of taxes. Strong ego, weak judgments. By the way, what he's talking about here, if you're investing in stocks, it's actually tax different than futures are. Futures have a very advantageous for tax purposes. Matter of fact, they're treated like long-term holdings, even if you're day trading in and out of futures, like we are. They are taxed at a long-term holdings type thing. I know I was talking to one of the hedge fund managers, a buddy of mine up here, and he's like, "Oh yeah, you should get into something where you hold on longer." And I, we went over that, and he goes, "Oh wow, that excellent," because he doesn't trade the futures. He just puts in different stocks. So we were looking at that together, and it's great tax advantage for being in futures. Okay. Skipped over 14. Number 15. Novice investors like to put price limits on their buy and sell orders. They rarely place market orders. This procedure is poor because the investor is quibbling for eighths and quarter of a point, Dustin, rather than emphasizing the more important and larger overall movement. Limit orders eventually result in your completely missing out on the market and not getting out of a stock that should be sold to avoid substantial losses. I thought that was really good. Number 16, part of this, they're unsure because they really don't know what they are doing. They do not have a plan, a set of principles or rules to guide them. Therefore, they are uncertain of what they should be doing. Number 17, most investors cannot look at stocks objectively. They are always hoping and having favorites. They rely on their hopes and their personal opinions rather than paying attention to the opinions of the marketplace, which is more frequently right. And that kind of echoes what we went over earlier about what is the market telling you. Number 18, investors are usually influenced by things that are not really crucial, such as stock splits, increased dividends, news announcements, and brokerage firms or advisory recommendations. All right, that was it there. The very end, just kind of Schwager's summary here. He said, trading success requires three basic components: an effective trade selection process, risk control, and discipline to adhere to your first two items. All right. The next one will be David Ryan, stock investment as a treasure hunt. And let's get into the homework section here. So I've got let's get my daily back up here. All right. So I have here in the daily, this is so we did have today on Juneteenth, whatever that's supposed to be. It wasn't on the calendar when I was growing up. But today on Juneteenth, it looks like we did break below that 3-bar. So we broke below it. So caution, the break of the 3-bar could just be a false breakdown and then move back to the upside. So right now in the Globex session for tonight, leading into Friday the 20th, we're back up in that area. So that could have been just a quick little false breakdown for a move back up here. So we always want to be conscious of that. I did want to show the 240-minute. So the 240-minute, guys, we had this move up here. We're kind of, doing this little angle. I've got one of the gaps marked below here. That was that Asians Gone Wild gap that it left. But you see I've got the 3-bar marked off here at 79, up here to 61.09. We broke below it on Juneteenth. and now we've made a move back up, or making a move back up here. This is interesting because I had this in my notes earlier, and wow, it may be playing out already, but we'll see. Well, here I'll zoom in on this. What I had in here is a potential for a sell ante play up here around this 20 period moving average of the 240-minute chart. We've got kind of this impulse down, although we've found support, potential support here on this 59.80 zone, 79.80 zone, push back up there to the moving average. So basically what I would look for tomorrow is if we continue this move up here, and the slow lines down, I would look for if the fast line starts rolling over. If the fast line rolls over there, that could be the sell ante. It doesn't have to be right here at this moving average. It could be up a little higher, wherever that comes in at. So I would look for a rollover of the fast line on the 240-minute chart for that sell ante type play. On the see. Oh, no, sorry. Over here on this chart. On the gap chart, let's look at okay, so this is the 60-minute. I'll leave let's go back to 15-minute first. So on the 15-minute, keep in mind this is a gap here from the 18th. This is Juneteenth. Here, this gap will change in the Globex session because this was not real-time trading hours for the U.S. So we, wherever we happen to be in our price point, matter of fact, let's see. Right now we are at prices are at 60.19 and a quarter. So 60.19 and a quarter. Well, we're already back up. Fairly close to where we closed on Wednesday. So, like I said, this gap will change, overnight here. So keep an eye on that. Yeah, so you have a little bit of on this move down here on the Globex session, or whatever happened on Juneteenth here, you are seeing a little bit of bullish divergence on the LBR fast and the MACD there. And then let's jump back out and look at the 60-minute version of this. Again, this is the .D chart. So I showed, we had, oh, come on. Okay. Yep. We have these other gaps below here. We are getting closer. So we're kind of moving back down here, getting a little bit closer in here. But as for right now, we're kind of bouncing off this 79.80 zone here. However, look at the fast line here. Did start to flip up ever so slightly on that. The MACD, however, has not flipped up. So we'll see kind of how that unfolds tomorrow. We are getting closer to some of these gaps below. With this move here, we are getting closer to potentially pushing down into some of the zone here. So we got to keep that in mind, that if it starts, trickling down or even shooting down, we do have that down below us still. All right, the SPY. Oh, I did want to show this. So you notice on the ES, we've hit the 20-period moving average. Those couple times, bounced off it, tried to go back up, failed it so far. Then on Juneteenth, we moved back below it. Here in the Globex session, we're moving back above that 20-period moving average. So now let's look at the SPY. The SPY, this closing date here, this is the 18th, because the SPY was not open. U.S. markets were not open today. So we, that did not trade today. So you're only seeing the future stuff overnight. Instead, we kind of have two closes here. I have this 595.48 level marked off here. Just kind of keeping this in mind. If we try to push back up here and we failed to come back up here, if we move back down below here, we could see a further breakdown. Again, as of right now in that ES, just a reminder, on that ES, we're bouncing back up to where we closed on Wednesday. So on the SPY, it'll be interesting to see where we open up tomorrow morning. Um, if we get down below this, like I said, I could see a case for weaknesses pushing down towards those gaps. However, if we stay above that, bounce off there, stay above that, well, then it's just the price is not ready to break yet. I'll say that the price is just not ready to break yet. I believe it will. It's just not ready yet. So keep an eye on this over under on the SPY. If you'll help me remember that tomorrow as well, to periodically look at the SPY to see where we are on that price point there. Um, oh, okay. I did want to show this. So this pattern. Remember, we've shown this pattern here. That hey, that slow line is just staying above. That's be careful shorting too soon on that. Also, that's that same pattern still showing forth on the ES, getting a little bit weaker, possibly ready to start that breakdown now. But that pattern is still present in both the SPY as well as the ES. Okay, if we haven't moved back up, don't fight it just yet. Like I said, I'm kind of looking for that, watch that 240, see if we have a sell ante type setup come in. The weakness that unfolded today on Juneteenth, we just need to be cautious to see where we actually open up tomorrow and see how that plays out on a Friday environment. So that's it, guys. Sorry, a little bit longer tonight, but we will follow up tomorrow. Happy trading, good trading, and let's trade safely tomorrow.